Drew Pettit, Director of U.S. Equity Strategy, ETF Analysis and Strategy Research at Citi, is now joining in. Drew, thank you very much for joining in. Well, I believe Citi's base case for the U.S. markets is that it's going to be a volatile year, but a good year. I think for the S&P 500, your target is 7,700 by year end.
Yes, it is. So we're above, I would say, street average there. But the key driving all of this is we're a street high on EPS for 2026. So look, noise is going to come from headlines. Noise is going to come from rate volatility. It's going to come from dollar volatility. Everything basically we've experienced to start 2026, kind of like a little bit of a mini 2025 for what it's worth. But at the end of the day, it's fundamental resilience. It's earnings moving up and to the right. The secular growth stories remaining intact, and the cyclical stories in the United States actually supporting further earnings growth that has us really comfortable with U.S. markets this year.
The start of the year has seen heightened, geopolitical noise with respect to so many issues, whether it's Venezuela, Greenland. As of now, Europe still hasn't responded to whether the EU-US trade deal, which they said was suspended about 24 hours back. They haven't responded on that to say whether work is back on track with respect to that. You don't see any shift to the U.S. fundamentals based on what we've seen so far?
Not yet. And I think the lesson we learned in 2025 was not to be overly reactionary to headlines. Let's wait and see what happens. I know this really isn't the most attractive or fun approach when we think about trading markets this year. But again, taking the lessons from last year, we need to see when this will actually come through and affect fundamentals. Because at the end of the day, there's a lot of really important secular stories that are at work that policy shifts might not completely upend. So again, earnings revisions, that is, have been really good in the United States. That trend, as long as it continues, we can live through this noise.
Hi, Dhruv. Good morning and good to see you, Ben. You've been more or less neutral on India. Now, we have underperformed over the last 12 months and more recently as well. 2026, we have started off on the back foot. What will make you get positive on India? Do you think this time and price correction is enough? Because we're expecting earnings to pick up from here on.
So again, we're watching earnings revisions globally. It's actually a big theme that our team talks about, not just in the United States, but in Europe and Asia as well. Earnings revisions changing really could drive, I would say, allocation shifts. That's a big determinant for us. When we think about EM as a whole, it is really attractive. And that's been a pretty clear overweight for us. The other area, again, India doesn't play to this. Why it's neutral in our framework is you get a lot of attractive AI names at a reasonable price when you think about markets like Korea and Taiwan, for example. China to a lesser extent.
Got that. Drew, there's all this talk of a bit of a sell-off in global equities led by the long end of the Japanese bond market misbehaving. You think it'll come to, it'll happen? Yeah, I mean, bond yields, perhaps many believe that's the one to watch eventually, and that can spoil this party. But otherwise, I mean, look at growth expectations in the US. The IMF recently put out some numbers. The high-frequency data out of the U.S., I mean, other countries, etc. as well. I mean, generally, it's a reflationary kind of an environment, if I can put it that way.
Yeah, that's a positive for risk assets. Look, it is funny. Like, to your point, you're right. If we get bond market volatility, rate volatility, whether it's in JGBs and how it feeds through to U.S. Treasuries, that's going to affect how much you pay for risk assets. But the balancing act on the other side is, even in that more volatile environment, if you actually get growth that's higher, it becomes a bit of an offset. So a bit of a push and pull. But for valuations being at really high starting points, to get comfortable with the 7,700 target in the US and low double-digit upside globally, you really need bond volatility to compress and stay low and rates to stay low. That's how you get sustainable higher valuations and really get that growth tailwind all at the same time. You need both.
Yeah, but I'm just saying that growth-wise, it's looking all pretty steady, right? I mean, we're kicking off 26 on a very steady note.
Yeah, we're really fundamentally bullish. There's still a lot of stories where we see margin improvement even in the United States. yeah, earnings keep going to new highs. That tends to drive stocks higher. Again, growth is a pretty good cure-all for other worries. Let's, push out a little bit of the noise that we're dealing with to kind of kick off this year. At the end of the day, EPS higher, price is higher.
Yeah, absolutely. Drew, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate you coming on here early morning on CNBC TV.